Good day. My name is Rossouw and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworx sees the way forward. This week saw French President Emmanuel Macron impose a national COVID lockdown on his country for the third time in a year. Armed gendarmes are patrolling the streets of Paris and other cities once more as a combination of virulent new coronavirus strains and slow vaccination rates saw new daily infections approach 40,000. Other EU countries are grappling with similar situations, and the European Commission has been widely and justifiably criticized for its clumsy handling of the vaccine rollout. As of Friday morning, more than 130 million people have been infected with COVID-19 worldwide, and over 2.9 million people have succumbed to the disease. The United States remains hardest hit, with 31.2 million infections and over 565,000 deaths. Brazil, India, France, and Russia now make up the top 5, and South Africa is down to 18th most recorded cases. The crisis in Brazil seems to have reached a plateau, with new daily infections down from their highs around 75,000. Brazil's vaccination program is starting to gain traction, and mitigation measures have been imposed at state and local government level. Thanks to a relentless vaccination program, the United States is closing in on population immunity, but India is a ticking time bomb. Hot on the heels of the Holi festival celebrating spring comes the holy month of Chaitra, with several festivals which have the potential to become super spreader events. Brazil has just endured its worst weekly coronavirus death toll since the beginning of the pandemic, and more than 3,000 people are dying every day. Even though the infection rate is starting to moderate, April is going to be a miserable month for the country and its beleaguered health system. Mexico has just admitted that there has been a serious underreporting of COVID deaths, and several European countries have also seen significant rises in mortality rates. Globally, over 620 million people have now received at least one COVID-19 vaccination, just under 8% of the world's population. The United States leads the way with 154 million vaccinations, followed by China with 127 million, India with 69 million, and Britain with 36 million. Although large and/or rich countries understandably dominate the absolute numbers, some smaller countries have achieved remarkable results, most notably Israel, the United Arab Emirates, and Chile, the first 3 nations to have attained population immunity. The Suez Canal has been reopened, but global shipping backlogs will persist for some time. In the United States, the Democrats want to spend $2 trillion on renewing the country's antiquated infrastructure, and the bond market is still nervous about the inflationary pressures this might unleash. American businessmen are the most bullish they've been in 2 decades, but there is concern about the recent sharp drop-off in Chinese business confidence. Interest yield movements in the United States reflect the market's expectation that inflation is about to take off and remain higher for longer. Since the beginning of the year, all the benchmark yields have risen, including the 10-year inflation-linked Treasury note, the orange line. Should market expectations be proven correct, the resulting higher interest rate environment could have a negative impact on the equity market as well as the underlying economy. Of all the world's major economies, China performed the best during last year's recession. Despite the pandemic, it managed to grow its GDP by 2.3%, and the IMF is currently forecasting growth of 8.1% this year. Now there is growing concern that China's recovery may be stalling. The country's Manufacturing Purchasing Managers Index has been in decline since December, and in March it fell to 50.6, its lowest reading since April last year. Both output and new orders disappointed, while input costs rose. In Japan, the other Oriental giant, matters could hardly be more different. The Japanese economy contracted by 5.1% in 2020, but it has been on a steady, if unspectacular, growth path since the middle of last year. The IMF predicts that Japan's GDP will grow by 3.1% this year, and judging by the consistent rise in its manufacturing PMI, the country is on track for solid growth this year. Both output and new orders rose at levels last seen late in 2018. US equity markets were re-energized this week by the news that the Biden administration plans to spend $2 trillion on infrastructure projects, with the S&P 500 reaching a new high on Thursday. Wall Street is still the engine room for global equity markets. Without the US, the MSCI World Index is up 4.1% for the year to date, but if the US is included, the number rises to 5.7%. The upward pressure on the oil price may subside a little if OPEC keeps its word and the dollar stays strong. Meanwhile, Microsoft has landed a lucrative contract to help train American GIs using augmented reality technology. Most equity markets ended the week higher, but March was a slow month with the main Chinese indices the laggards. The DAX in Frankfurt continued its rise in March, with China's A50 and Hang Seng bringing up the rear. The Russell 2000 in New York and South Africa's top 40 are still jostling for the top spot for the year to date. Over the past 12 months, the Russell 2000 remains far ahead of the pack, with London's FTSE 100 the wooden spoonist. Over 3 years, the Nasdaq reigned supreme, with the FTSE and Hang Seng the worst performers. The stronger US dollar, combined with weaker Chinese demand, caused commodity prices to soften mostly in March. The two notable exceptions were oil and platinum group metals. For the year to date, oil prices are up by more than 20%, while copper, platinum, palladium, and aluminium have also made impressive gains. Gold and silver are the big losers so far this year, and concerns over rising interest rates won't help their cause. We remain positive about global equities, but we expect a continued rotation out of technology to more cyclical sectors. We also expect emerging markets to outperform developed markets, the East, the West, and Europe, the United States. The biggest risk to the equity market is rising bond yields. We remain skeptical about fixed income where yields are still negligible. We worry about the inflation fears that could trigger a fully fledged sell-off. We remain neutral about property, which, whilst cheaper than pure equities and yielding better than bonds, are locally, the battle for the soul of the governing ANC is continuing. During a long and acrimonious meeting this week, the National Executive Council reiterated an elective conference resolution that members facing criminal charges should vacate their posts, but then backpedaled and added that they had 30 days to do so before the Integrity Committee would act against them. Secretary General Ace Magashule, the acknowledged leader of the radical economic transformation faction, many of whose leaders are under indictment, continues to defy calls for him to step down, and time will tell whether the party will act meaningfully against him. As of Friday morning, more than 1.5 million South Africans have tested positive for COVID-19, and nearly 53,000 people have succumbed to the disease. 51 new deaths were reported on Thursday, and 270,000 health workers have thus far been vaccinated. Gauteng has the most infections to date, with more than 414,000 cases, while the Western Cape's 11,464 is the highest provincial death toll. The Easter long weekend is likely to cause a fresh spike in infections due to the large numbers of people traveling and converging at religious gatherings and holiday resorts. According to Statistics South Africa, 80,000 new jobs were created in the fourth quarter of last year. SARS managed to collect 38 billion rand more than budgeted in the past financial year, with total tax revenue amounting to 1.25 trillion rand. The petrol price will reach a new all-time high next week, and new vehicle sales are starting to pick up. Students have called off their nationwide protests after government undertook to increase financial support, and our maize farmers are exporting more than ever. South Africa's GDP contraction of 7% in 2020 was its worst since the Great Depression of the 1930s. Since World War II, we have only experienced 4 other annual contractions of more than 1%. During the second OPEC oil boycott, after our sovereign debt default following the Rubicon speech, during the emerging market debt crisis of the 1990s, and most recently during the global financial crisis of 2008-2009. Public finances remain South Africa's Achilles heel. We are by no means a poor country, but thanks to corruption and bureaucratic incompetence, much of our tax revenue never reaches the intended beneficiaries. This table summarizes the Auditor General's report on provincial government finances during the past financial year. Only in the Western Cape did more than half of departments receive clean audits. The figures for North West and the Free State were 4% and 6% respectively. Unauthorized expenditure in the Eastern Cape totaled nearly 1.6 billion rand. Irregular expenditure in KZN totaled nearly 10 billion rand, and fruitless and wasteful expenditure in the 9 provinces came to a whopping 312 billion rand. Because so much of South Africa's maize crop is produced in areas with marginal rainfall, crop sizes vary widely from year to year. This infographic depicts how our farmers have fared over the past 2 decades. A major drought in the early 2000s saw imports, the light blue bar, surging and South Africa becoming a net importer of maize. Things then improved until 6 years ago, when 2 consecutive years of drought hit us again. Following on 3 good years, this season South Africa will probably not import any maize whatsoever and export nearly 2.7 million tons. The JSE remains one of the world's best performing stock exchanges for the year to date, with both the resources and industrial sectors up by more than 14%. The bond market is down slightly for the year to date, while the rand-dollar exchange rate is back at its January 1st level. Ratings agencies are washing their hands of the South African Land Bank, and Old Mutual's UK sister company Quilter has sold its non-UK subsidiary. The Competition Commission has meanwhile approved Mr. Price's acquisition of Power Fashion, to the delight of Mr. Price shareholders. The past 12 months saw wild gyrations on local capital markets. After a sharp correction in March, the JSE All-Share Index, the red line, produced a surge that lifted the index by nearly 54%. South African bonds, the grey line, were in demand thanks to their attractive real yields, but with developed market yields now rising, the bond market has become becalmed of late. The listed property index, the light blue line, remains an enigma. It was hugely volatile last year, but rallied in the fourth quarter. We remain cautious of property, as many property counters remain heavily indebted, and only time will tell what long-term impact the pandemic will have on the property sector. Foreigners seem to have rediscovered their appetite for South African equities and bonds. Last week saw net foreign buying of just under R500 million worth of local shares and just over R1 billion worth of bonds. For the year to date, however, net flows remain negative, with the JSE losing over R9 billion and the bond exchange more than R28 billion. Despite many ups and downs during recent months, the rand remains resilient in the face of a resurgent US dollar. The local currency started the year at around R14.60 per dollar and then embarked on a roller coaster ride which saw it touch both R14.50 and R15.50 to the dollar at times. It is currently back around R14.60 to the dollar and remains one of the best performing emerging market currencies for the year to date. Locally, the equity market has been strong so far this year, but valuations are still fair and prospects for earnings growth look promising. Real bond yields remain attractive, but we remain mindful of risks to the fiscal outlook going forward. We continue to avoid listed property and regard cash merely as a liquidity tool because of the low interest rate it offers. The Adviceworx PCS asset allocation view can be summarized as follows. Because of the economy and the weak rand, we remain overweight global equity and underweight South African equity. We remain neutral on global property where valuations are reasonable, but negative on South African property. We hold no global fixed income, and we remain overweight South African bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.